Hey, good evening. This is a 2-video day. So I wasn't in Nashville, but I heard some interesting topics. One was the idea of retainers, and I want to tackle that pretty hard right now. So let's dial back. I got a call 2 weeks ago from a decent-sized company doing about $1 million in revenue, and the young lady was trying to determine whether she wanted to sell her business or not, her and her husband, and they wanted a valuation, and she asked me how much she or I would charge her, and I said nothing. And she said, really? And I said, why? Are people charging you for valuations? She said yes. She called 3 brokers in town, and they had all wanted anywhere between $1,500 to $4,000 to do a valuation on their business. And I kind of laughed. I didn't kind of laugh. I actually laughed. I said, quote unquote, I said, why would they give you a reason to say no? To which she said, exactly. So today, this morning, she called back, sent me the valuation, did the valuation for free, took me all of 5 minutes. It's a distribution company. I had already won her over because I wasn't taking money from her. And I will sell that business. So, retainers. The idea of a retainer only works in a market where you have market share. And if you think back to a couple years ago, the last time you saw me speak at a convention, I said, you gotta have market share. I'm a Pepsi guy. Shelf space matters, market share matters. It allows you to shape the battlefield, it allows you to shape the market. And then you can do, if you have 100% market share, and you have no competition, you can do what you want. You can charge retainers. However, you run a couple of risks. You run a risk of resentment, that you're creating value and that you're delivering, because if you don't sell, and even if you're really good, you only run a 40% likelihood of selling the thing, that if you don't sell it, they're going to feel like you got ripped off, and you run a real risk of them saying bad things about you in the marketplace or online. You also run the risk of creating a vulnerability to do exactly what I did to my competitors. Now, I found out who they were asking for retainers, and the reason they're doing it is because they're smaller firms, they don't have a strong balance sheet, they don't have market share. But it was real easy for me to create a differentiator of space, along with my already charming personality and reputation, to win the engagement and get the commission. So, for the record, the reason you're charging retainers and the reason you're charging BOVs is because you don't have market share and you don't have enough listings and you got commission breath and you're looking for a way to make a buck. And in my opinion, it's incredibly short-sighted and not really how you dominate a market. I'm going to give you that Steven Crowder sitting at the sign on the college campus. Prove me wrong. I'm in a hyper-competitive marketplace. Hyper-competitive with some really good brokers. But their balance sheets and their inability to cash flow creates the need for these schemes. And at a fundamental level, you do not want to give a customer a reason to say no. People say no for a lot of reasons. People say no because of money. People say no because of cost. People say no because of personalities. People say no because of racism. People say no because of ignorance. Let's face it, our buyers and our sellers aren't always the most educated. That's not always their fault. But we still got to make a buck. So do yourself a favor and do the blocking and tackling. Get listings. 10 listings, not a lot. 20 listings is not a lot. You want to have 40, 50 listings in a city, because your competitors will just have 10. You'll be just like them. You want to differentiate and not give the customer a reason to say no.